You have to look at this name, and I agree. This is a name you're going to want to keep your eye on. And retail, I think this is the potential 2019 turnaround in my space. You know, this is a name that has not seen the upside that the retail environment has gone through with positive comp inflections across the board. This is a name that struggled. To your point, it's down 65% off its highs. Here's what I think is most important. You're right. This is not about a top-line inflection looming in the next quarter or two. This is about optimizing the P&L first and foremost. What they're doing is they're starting to look at costs and expenses and profitability in a much more strategic way, telling you about Henry Bendel and Licenza, these money-losing businesses, starting to optimize the structure there, getting those off the P&L. And then from that point forward, that's where you start to see a re-rating in the shares. And so I think it starts first with looking at the expense structure and profitability first. And then from there, I think the vision then leads to a re-rating of the stock. And that's kind of what we're hoping for.
Ike, you've said you'd like to see the dividend cut by 50%, that would make something that makes sense to you. It's Victoria's Secret, though, that's really struggled here. What happens at that brand? How do they fix it?
Yeah, so first and foremost, I agree. The capital structure, what we wrote today, we think it needs to be optimized and changed. The 7% dividend yield today, I don't think that's the go-forward yield. I think this is a company that probably takes that dividend and cuts it in half. I think then you use that excess cash flow the company's throwing off, and you start to pay down some debt. Remember, they're a little bit levered. They're 4 times lease adjusted levered. That's a little high for retail today. So I think that would be a good decision in terms of optimizing the capital structure. At Victoria's Secret, I think that margins are down about 10 points from their peak levels. I think this is a company that will almost admit that they've been slow to adopt change. They've made some decisions around cutting out the swim business, cutting out the catalog. These were things that happened a couple years ago that I think they need to start to rethink, and maybe they will. And that's really key to this story in terms of that's when the top line can inflect.
So what do they? You mentioned a couple of the brands that they have or either announced they're going to exit or you think they will. Are there others that they need to? Number one, and number two, have they been as efficient and effective as you would like to see them be in selling through a digital channel?
So they've been decent on digital. It's about 15% of sales. That's pretty much the norm. The Bendel and Licenza are the first steps. There's not money-losing businesses outside of those, but here's what's important. They are still, I would argue, overstored in North America. They're at their peak North America door count. I don't think many retailers in 2018 are at peak door count. So I think the real estate rationalization is a beginning. Also look internationally. This used to be a brand that we thought could make tons of money overseas. They're now losing money overseas. They took a lot of those businesses in-house. China loses money, Europe's losing money. There's optionality in the P&L. And that again, that's where we're starting to focus today. The top line can inflect later. This is about a re-rating and looking at the profitability first.